So, Scott, what are your top stock picks for 2021? And can you tell me why?
I think it's really important as an investor to make sure you are riding the wave of the future. Now, for young people, I don't have to tell you, the future is coming, the future is here, and you guys are going to be inventing it. But there are some businesses that I think are going to do really, really well, largely because, by the way, of what you're doing as consumers and what your friends and colleagues are doing as consumers and investors. Let's go with the first one. The first one is Aussie Broadband. Now, telcos are old, they're boring, they're staid, there's not much growth in the industry, except if you're a new disruptor, an innovator with a brand new culture, you're doing things a little bit differently, and you are bringing the love. Aussie Broadband, ABB is the code, is a business that is absolutely creating an immense amount of love among consumers. I've been on Twitter before saying, look, Telstra's giving me the irrits. And frankly, I'm trying to get Telstra to do something, by the way. In the meantime, I have dozens of people say, hey, have you tried Aussie Broadband? It's great. You should try it. When a boring telco can get that sign of customer love, that's a really, really good sign. They're new, they're innovative. They don't have the legacy culture, the legacy assets, the legacy way of doing business of the big guys, the old guys. When you get to start from scratch, and if you hit escape velocity, you can do really, really well. So that's Aussie Broadband, ABB. The second one is a stock that is an ETF, an exchange traded fund. They're all the rage these days, and for very, very good reason. I love low cost, broad-based, index-based ETFs. This one is a NASDAQ-based ETF. NDQ is the code on the ASX. Why NASDAQ? These are the businesses that are, it sounds like a horrible, boring marketing line, but it's true. They are literally inventing the future. Think about Google, Apple, Facebook, Tesla, Netflix. I can roll another dozen on top of that. MongoDB. There are so many of these businesses that are literally inventing the future. These are the growth businesses of today. And frankly, either them or the upstarts in the same index are going to be the ones that are creating innovation of tomorrow. Again, we know how well they're doing this. By the way, most of these businesses are growing revenues at 20% plus a year. Even when you're the size of Amazon or Google or Apple, just a phenomenal, phenomenal track record. And I think a lot of promise. It gives you international exposure. It gives you diversification by industry, not as many tech stocks here. Great currency diversification. And as I said, some of the very, very best businesses of our time. All right, let's go to the third one, Kogan.com. Something of an Amazon imitator. They don't even mind that, by the way. They're a bit chuffed to be compared to Amazon. This is a business that's really struggled over the past 6 months share price wise. And they had a bit of a hiccup because they had too much inventory. They made a bet. Will sales keep growing at the same rate just in case we'll order some stock? Well, they didn't, because we kind of went back to the shops a little bit, got stuck with a whole lot of stock. The market freaked out. This is a $27 stock in November last year. Now just over $10. I own shares in this one, by the way, as I do in the NASDAQ Beta Shares ETF. So I want to be really clear about that. But Kogan, code KGN, is a business I think is going to be more relevant to more people in the future. And if you think about as an investor, you want growth businesses, you're looking for businesses that are more relevant to more people more often. Now, I don't know about you. I'm certainly ordering more from Kogan. My friends and colleagues are ordering more from Kogan. This is a business that is going to keep growing. 3 million of us on their database, by the way. I think it's a long-term growth story. If it is, they will recover from the inventory problems. They will continue to grow. And if and when they do, I think the share price will be a whole lot higher. So I like Kogan. That's KGN. I think it is a business that with Amazon, by the way, I don't have to beat Amazon to do well. Amazon will probably win the Australian race. Kogan will probably be a good number 2. That's a great place to be, I reckon, if you're a Kogan shareholder, as am I. All right, let's go to RPM Global. This is a business you probably haven't heard of. It's a company that does mining software, which sounds incredibly boring, but it's really, really important because, hey, if you're going to dig a new mine or operate one, you're going to want to know what's going on underground, what you're planning to do, how you're planning to do it. That's what RPM Global does. Now, it's a relatively small niche business in a relatively big industry, but it's a really, really mission critical piece of software. Here's the good news, by the way. You guys know software as a service, right? That's the idea of paying monthly or yearly for access to a piece of cloud software. It wasn't the case only 10 years ago. I'm a little bit older than that. I remember the good old days when you had to download them on a floppy disk and whack them in your computer. That was a while ago. These days, software as a service is all the rage. RPM is going from a perpetual license, which is sell it once, use it forever, to a, hey, I'll charge you monthly or yearly for access. And that's a remarkably profitable, remarkably successful business model. RPM's in that valley between high levels of perpetual sales and high levels of ongoing software as a service sale. Right now, they're in the valley between those two because you're not making really big ticket sales, so you're losing that. You're not yet getting everyone on software as a service. You haven't got there yet. You're in between. The market hasn't yet cottoned on to the change, at least not in the price. That makes RPM Global a really, really attractive long-term business proposition as and when it makes that transition. All right, let's go to company number 5. I like a glass of wine. Maybe you like a glass of wine. Treasury Wine Estates is the granddaddy of Australian wine companies. It houses Penfolds, Wynns, Lindemans, among others. If you don't drink it yourself, I guarantee you someone in your household or someone in your street does. Plenty of us do. I'm guilty as charged. It's having a really, really tough time recently because it got booted out of China. Well, not exactly, but tariffs of 175%. Will do that if you're a winemaker. How do you sell your wine when it costs almost 3 times as much as it used to? Very tough. Their sales are at about 97% in China. Like Kogan, the short-term issues there have really hit the share price. By the way, like Kogan, I also own shares of Treasury. It's hit the share price really, really hard. Now, here's the thing. They have managed to find growth in the US and Europe and Australia when they've, funnily enough, changed their focus. And the good news is, I think the China story will recover. And if and when they get back into China, that share price should go back up as well. That's Treasury Wine Estates, TWE.